Welcome to 57 High Priority Safe Exam Mortgage terms 49 through 57. My name is Rich Leffler, and I'm the Senior Exam Instructor, founder of Accelerated Development, where we've been successfully preparing people for the SAFE exam for over 17 years. Let's do this. Credit and underwriting terms. Credit report, a snapshot in time establishing a consumer's current credit profile. Credit gets damaged, credit heals. A poor credit profile at the moment does not mean that that will be the case forever. Similarly, a person with stellar credit can easily have their credit damaged based on life circumstances. Creditworthiness is an assessment of a consumer's ability and willingness to repay a debt. An underwriter will approve or decline a loan based in part on the applicant's creditworthiness as reflected on his or her credit report. Underwriting. This is the process of evaluating an applicant's ability to and likelihood of repaying a debt, along with the property's suitability to collateralize the debt. Just because someone might be creditworthy themselves does not mean that if life happens and they lose their ability to repay, that the home that collateralizes the property is going to be suitable. So in addition to underwriting the borrower at the time of application, the underwriter also underwrites the property through, among other things, an appraisal report. Automated Underwriting System, or AUS. This is the computerized software system used to underwrite loans intended for sale to Fannie Mae or Freddie Mac. Fannie Mae's AUS version is DU, or Desktop Underwriter. Freddie Mac's is LPA. Compensating factors are positive characteristics used to offset an applicant's weaknesses. So let's say there's an applicant who has not so ideal credit scores, or maybe not as much of a down payment as the lender would ideally like to see. So the loan to value is higher, or perhaps maybe their debt to income ratios are slightly higher than the lender is comfortable. If there's a problematic component to the applicant's overall creditworthiness, that could possibly be offset through a compensating factor. So for example, maybe the LTV is a little higher than ideal, but the borrower has exceptionally high credit scores. Or maybe the debt to income ratio is not ideal, a little bit higher than the underwriter would like. But the borrower has such an enormous down payment that the loan to value is extremely low. Something to positively offset something negative is referred to as a compensating factor. The 4 C's of credit. C number 1 is capacity, the applicant's ability to repay the debt. C number 2 is capital, the applicant's assets available to satisfy the purchase's down payment, the loan settlement fees, the loan's prepaids, and the loan's required reserves. C number 3 is character, the applicant's willingness to repay the debt, refers to credit. And C number 4 is collateral, the property pledged to secure the debt. If you are interested in a video through which I go over all of this in much greater detail, please look in the description where you'll find a link through which you can access them. Furthermore, should you find yourself in need of additional safe exam prep resources, products, and services, please visit us at Accelerated Development, www.safeexamtraining.com, where we got your back, Jack, when it comes to preparing for the SAFE exam. Good luck.